It's great to have you all join us today. The late Charlie Munger had said, the first rule of a happy life is low expectations. Well, even with high expectations, I'm just so pleased with the wonderful turnout that we have today. Charlie also advised us, spend each day trying to be a little wiser than you were when you woke up, day by day, and at the end of the day, if you live long enough, you will get out of life what you deserve. In that regard, I'm certain that we're spending today well. My name is Harkishan Tanwani, and I'm so delighted to introduce Vishal Khandelwal to Bangkok. Vishal has been a dear friend and teacher. He's a founder of Safal Niveshak, a unique education initiative which has touched the lives of so many people worldwide. He's the host of two popular podcasts, The 1% Show and The Inner Game. His book, The Sketchbook of Wisdom, which you're holding, is a manual on virtue and happiness, on how to live in peace with oneself. Morgan Housel, one of the greatest financial writers of our time, calls it a masterpiece, and I could not agree more. My colleagues and I have benefited tremendously from Vishal's blogs, journals, and courses. So when we knew that Vishal would be in town, we could not resist the opportunity to have him share with us today his philosophy on investing and life. After the presentation, we will be able to answer questions from the audience. Today's Q&A session will be moderated by a very special guest, Dr. Andrew Stotz. Achan Andrew has been a mentor to me and a role model. With over 3 decades of teaching and working in finance, Andrew brings valuable insights to listeners of his podcast series, My Worst Investment Ever. He's a founder of Stotz Academy, former president of CFA Society Thailand, and twice voted as Thailand's #1 analyst. So we're in for a real treat. And now I'd like everyone to welcome Vishal to the stage.
Thank you. I'm sorry. Thanks, Hari, for that kind introduction. And good to be here on the stage instead of down there, because I can now look at the camera and not look at the eyes of people staring at me. So you've been very kind introducing me, Hari, and he's been a very good friend. Our friendship has just grown over the last few months. Charlie Munger, he quoted Charlie Munger, and the one idea of Charlie Munger that is very close to me is what he calls a seamless web of deserved trust, where people connected to each other, they trust each other so much, right? So that there's a seamless web all around, right? And I can see that web in this room today, where I can see almost everyone knowing each other, trusting each other. And this is the first time when I am talking to people who know each other and they trust each other. So thank you for having me. Thank you for organizing this session. Before I begin, just to notify, so Slido, I think Andrew is going to ask me questions, and you just need to go to slido.com and you need to enter this code number, and you can send your questions also anonymously, right? And we'll be seeing those questions. We'll be answering those questions near the end of the session. So my subject today is the art of investing. Hari told me that people in Thailand and people in the audience have much higher IQ than I have, right? So I have tried to keep it extremely simple, right? This is what I am good at, right? I combine my average skills in investing with average skills in communicating, with average skills in illustrating, and that is what I have in front of you. And that's the reason I call it the art of investing. I'm going to talk about why I call the art of investing. And as Hari said, the secret of happiness is to have very low expectations. And this is also what I expect of you, that you don't have very high expectations from what I am going to talk about today, so that by the end of it, you're much happier than if you had, or if you start with high expectations, right? So keep your expectations lower. Nothing fancy that I'm going to talk about, especially people wearing suits, right? There's nothing complex that I'm going to talk about. I'm going to keep it extremely simple. He gave me a broader idea of the kind of audience that I'm going to see in this room today, and that's the reason I am going to try to keep it extremely simple. It does not mean that you guys have low IQ, right? As Einstein said, the highest level of intelligence is simplicity, right? And that's exactly why I try to keep it simple. Jean Cocteau said, art is science made clear. So art is the bridge that connects science with everyday living, right? So investing, we all understand, is part art and part science. When you start investing as a career or as an investor, you think it's science, it's a lot of maths, right? A lot of numbers, a lot of complex stuff. But as you grow as an investor, you realize it's more of an art. It's largely based on intuition. Of course, there are numbers that you need to study. Of course, you need to study sometimes balance sheets, the annual reports, the financial statements. That's a complex part, right? But it's art because it's largely about how we behave, right? It's a very personal thing. Investing for you may mean something else compared to what investing means to me. And Henry Ward Beecher said, every artist dips his brush in his own soul and paints his own nature into his pictures. So what I am going to try and talk today, and what I try and talk across all my courses and sessions, is what I really believe in and what I really practice, right? So everything that I'm going to talk about today, including the illustrations, I've done it all myself, right? But everything that I'm going to talk about today is what I personally practice, and there's nothing complex that you're going to see that I practice as an investor or as a decision maker. Another reason I try to keep it very simple is because I really believe in this technique called the Feynman technique. The Feynman technique is after Richard Feynman, who was called the next Albert Einstein. He was as smart as Einstein. And the technique simply means that if you want to really learn something in life, including investing, you should first study the literature which is all around, and then you should try to teach a young child, a 15-year-old or a 10-year-old, what you've learned. If you're able to convince him or her, and that the child is able to understand what you're saying, it means that you've learned it. If not, you have to go back to the literature and relearn it, right? And since I'm using a lot of illustrations, a lot of pictures, a lot of simple language in terms of explaining you the ideas, this is the technique which I am following today, Feynman technique. I follow this person called Thich Nhat Hanh, who was a Vietnamese scholar and monk. And he said that for things to reveal themselves to us, we need to be ready to abandon our views about them. A lot of times, a lot of us come to a session like this, or anywhere we go where we want to learn something, a lot of times we come with a lot of preconceived notions of what this session may be, right? Or what this, for example, as far as investing, a lot of people come with the idea that it's going to be complex stuff. It's going to be stuff about maths, investing, how to pick stocks, right? My idea is, when I start this session, as I said, is I would like you to be ready to abandon what you already come with, right? Be willing to listen to me with an open mind, right? As they say, it's only when the cup is empty that new knowledge can pour into it. So that's my idea of what Thich Nhat Hanh says. Can anyone tell me what this is? This looks like a beautiful night sky, right? This is actually a stock price chart of a company called Asian Paints in India, right? And that has compounded shareholder capital over many. So you can see the illustrations, right? So I try to communicate everything through illustrations. It makes it easier and you're able to remember the stuff that I'm talking about. So this is the stock price chart of Asian Paints and how the stock has compounded wealth over many, many years. Now, what is this? Thai stocks? Or a stock that has lost a lot of value to shareholders? In fact, this is nothing. This is just a random drawing, right? Now, the first lesson of investing is that we should not draw patterns from the past. Just because the previous slide was about a stock price chart does not mean that this is about a losing stock. A lot of times in investing, if we are in a bull market or if in a market which is rising, we all paint a very rosy picture for the future, and we think that what has happened in the recent past is going to happen in the coming future as well, which is not always the case, or not often the case, because markets always move in cycles, right? We have a good market followed by a bad market, and we have a bad market followed by a good market. When my daughter was 11 years of age, I wanted to teach her about investing, and we started by looking at companies that we interact with on a daily basis, right? So this is like a Peter Lynch way of looking at investing, things that you can draw with a crayon. This is what Peter Lynch said. You should invest only in things that you can draw with a crayon, right? Now, I don't really completely believe in this idea, because you can also draw a bad business with a crayon, right? But this is something which I drew for her in terms of showing her a few companies in India. These are listed companies in India, where you have toy companies, you have cloth companies, you have paint companies, you have electric appliances, you have plywood companies, you have air conditioning, retail, food, everything out there. right? And what we did, this was in 2014. And what we did as an exercise were to pick 10 stocks from this entire list. And I asked my daughter, who was 11 years of age that time, to pick 10 stocks out of that. And these are the 10 stocks that she picked at that point of time. So this is just a dummy portfolio I've been maintaining from that time based on her stock picks. And she was 11 years of age. May 15 to May 24, that portfolio has returned at 270% point to point, compared to the Indian stock market index of 200% and a Indian Sensex, which is a collection of the 30 biggest stocks in the country, which is given 174%. So my daughter has beaten the index starting when she was 11 years of age. And I have maintained this portfolio for long, in the sense that every time I talk, I show this portfolio of how someone without any knowledge can beat the market, right? But is this true? This is not true. There's something called the Dunning-Kruger effect. The Dunning-Kruger effect, named after the people who actually created that effect, was, it simply says that the less competent we are, the more confident we are, right? And it applies to everything, including investing. When you see the youngsters starting out in investing, and especially if it's a rising market, they start to think that it's their skill that is causing them to make a lot of money. It's not the skill, right? Probably you're getting lucky. And I'm going to talk a lot about luck versus skill investing. Investing is not only a game of skill, it's also largely a game of luck. But people forget because they suffer from what is known as the Dunning-Kruger effect. It applies to drivers, young drivers. It applies to any young people who are starting out into an activity. We start to believe that we know everything. But as time progresses, as we gain experience, as we meet accidents in the stock market or otherwise in life as well, we realize there's so much more to know. Right? And I also talk about the island of knowledge surrounded by a sea of ignorance. Imagine you are on an island, and that island is what all knowledge you have accumulated in your life. And everywhere around you is a sea of ignorance. What happens when the size of the island grows, which means you know more and more? When the size of the island of knowledge increases, so does the shore of ignorance, which means the more you know, the more there is to know, right? So this is a handy mental model to always keep in mind when you are starting out something, that you know everything. Because the wisest man in the world ever, Socrates, said that I am the wisest man because I know that I know nothing, right? There's something called the shop of knowledge, right? So there's a story about, I'm not sure whether it's true or not, but there's a story about a famous physicist called Max Planck in Germany in the early 1900, and Max Planck won the Nobel Prize for quantum mechanics, 1914 or something like that. And he was traveling all around. Am I clearly audible at the end, at the back rows? Yeah. So Max Planck was touring all Germany, around Germany, giving lectures on quantum mechanics, right? And people are applauding, okay, the greatest physicist of our times is talking about quantum mechanics. And he's given the same lecture again and again, different universities and different places. And he was always accompanied by his chauffeur, right? So chauffeur used to drive him across, and chauffeur was also a part of the audience in all the lectures. After around 10-15 lectures across different German cities, the chauffeur said, Mr. Planck, I think you must be tired talking about the same thing again and again. In Munich, let me give the lecture, and you wear the chauffeur hat and you sit in the front row, because nobody's going to recognize. There was no social media. So across cities, nobody recognized who the chauffeur was and who Max Planck was. So at Munich, the chauffeur was at the stage, and Max Planck was sitting wearing a chauffeur dress and chauffeur uniform and cap. At the end of the lecture, and he gave a perfect lecture, the chauffeur. At the end of the lecture, someone raised his hand and asked a question. Now, what happens when someone asks a question on quantum mechanics to a chauffeur? Now, the chauffeur was very smart. He said, how can someone in a big city like Munich ask such a dumb question, something that even my chauffeur can answer? Right? And the chauffeur answered it, because chauffeur was Max Planck. So in life and investing, we have two kinds of knowledge. One is Planck knowledge, the other is chauffeur knowledge. Right? A lot of times, especially when we are starting out, we have chauffeur knowledge, which means, as Feynman said, there's a difference between knowing something and knowing the name of something. So a lot of times we know names of a lot of things, investing, stock market, right, arbitrage, derivatives, futures and options, but we don't understand what that thing really means and what are the risks embedded in that thing, right? So it's very important for us to understand, do we have Max Planck knowledge or shopper knowledge. And if you suffer from the Dunning-Kruger effect, which I showed in the previous slide, right, most of the time you have shopper knowledge. So get over that. As humanity, we are getting smarter. This is the IQ chart of humanity since 1909 to 2013, right? If IQ, of course, it was not zero, but if the base was zero in 1909, we have accumulated 30 more points in terms of intelligence as human population, human civilization. So certainly we're getting smarter, and I'm sure you're looking at people around you, you're looking at your new generation, right? The kids are smarter than the parents, and then the kids are even smarter than the parents, right? That is how we are progressing as humanity. So we're getting smarter. But when it comes to investment horizons, right? Now these are not skyscrapers, these are investment horizons. So in 1960, the average holding period of a stock in New York Stock Exchange was 8 years, right? In 2020, it came down to 6 months, right? So while people are getting smarter, while we know that compounding works in the long run, people on an average are not willing to hold on to their stocks and investments for beyond 6 months. And I think 6 months is a very optimistic number. Now people buy in the morning, sell in the evening and say long term. Right? This is what happens for for a very large proportion of people. They're not even willing to buy for a few hours and they say, I think it's too long term, let me sell, right? This is what causes a difference between people who actually do really well over the long term and not. The chart, the line, the bar that you don't see, this is the only advantage that you and me have as investors in the stock market, because everyone else is doing 6 months or 3 months. How do you create an advantage? How do you really do well? How do you survive the stock market over 20, 30, 40 years? How did Warren Buffett do it? One of the secrets was that he started when he was 11. Now, if you've missed that opportunity, right, you don't need to go back. You cannot go back at 11 and start investing. But the most underrated skill of Buffett or Charlie Munger or any Howard Marks or any of the good investors you see in this room or around, right, it's because they did not interrupt the compounding machine. They bought early, they kept buying, and they just stuck on to where they invest. Of course, you also need to buy good investments to stick on for a long period of time. And it does not require a high IQ. As Buffett says, investing is not a game where a guy with 160 IQ beats a guy with 130 IQ. Once you have ordinary intelligence, what you need is a temperament to control the urges that get other people into trouble in investing. So all you need to do, once you have basic IQ, all you need to do is to control the temperament, control the emotional urges to buy, sell, trade, speculate, right? Buy bad businesses, invest only because the stock prices are rising, sell because the stock prices are falling, invest because someone else in your family or friend has advised you, probably Hari advises you, right? And you buy just because Hari is advising, Hari is buying, it doesn't mean that you should buy and you're going to make a lot of money. Probably he's making a mistake, right? And if you follow him blindly, you're also going to make a mistake, right? So have you heard of a guy called Mohnish Pabrai? Some of you. So Mohnish Pabrai is one of the best investors we have in the current times. And all he did, according to him, is that he copied Warren Buffett. Whatever Buffett used to buy, he applied his brains, of course. And he made those 1 or 2 decisions every year. And this is how he created a lot of wealth for himself and his clients, just by copying Warren Buffett. Right? Now, that copying also requires intelligence. You simply cannot cut, copy, paste. You need to understand whether you understand the stock or the business or not, whether you understand the business or not, whether the person whom you're copying, is he making a mistake or not, right? So we need to understand all those things. And as Buffett says, for that you require ordinary intelligence. And beyond that, it's largely about temperament. Now, what makes investing bulletproof? Bulletproof in the sense, right? Of course, there are going to be a lot of bullets coming at you in terms of market cycles, bad markets, right? Economic slowdowns, depression, epidemics, now we've seen. I mean, markets are going to go through very terrible cycles across over the next 10, 15, 20 years. And I'm sure a lot of people who've been investing, they have had experience of such kind of cycles and such kind of market environments. Now, how do you protect yourself against that? The 3 ideas, and I'm sure this is not related to investing at all, the 3 ideas that we've learned as we've grown up is patience, humility, and rationality. And this is the core of what I'm going to talk about in today's session. Everything that I'm going to talk about today's session is going to revolve around patience, humility, and rationality. Let's start with patience. Emerson, adopt the pace of nature. Her secret is patience, right? We've been taught to be patient while driving a car, while investing in the stock markets with people, right? Just be patient. This is what our parents and grandparents have already taught us, right? But when it comes to stock market, something happens, right? The same patience that we are able to apply in ordinary life, we lose it all when it comes to stock market because everyone else is impatient. So how can I keep myself patient, right? Look at this data. Now this is data from the US markets. I think similar numbers apply to all kind of markets with long history. Multiple recessions, right? So this is the number, the amount of correction, right? In the next 1 year, I think, what happened after every recession or a crisis or a war or a shock, right? Or a crash or a war, Asian crisis you had, right? This is where I think the Thai economy had the biggest hit, right? Tech bubble, COVID pandemic. In the next 1 year, I think few months, if I don't remember, I think the impact on the stock market was on an average 32%. The stocks on an average fell by 32%. But 5 years plus from that event, the markets on an average were more than double. Now there's no guarantee. It does not mean that every time the markets fall by 30%, they are bound to rise by 123 or 150% in the next 5 years. But investing is all about probabilities. There's no certainty. Even if you buy the best of business, you can still lose a lot of money. And if you buy the worst of business, you can still end up making a lot of money, right? And that's the reason it makes investing a game of luck and not skill. There's a wonderful book called The Success Equation by Michael Mauboussin, where he's laid out activities from pure luck to pure skill. So activities that involve pure skill, and those activities are like individual sports like chess, or you have team sports like football, basketball. And on the extreme right hand side, where you have pure luck activities, those are activities which are like gambling, which are like stock markets. And he says the way to differentiate between pure luck and pure skill is that if you can lose on purpose, that's a game of skill. And if you cannot lose on purpose, that's a game of luck. Can you lose on purpose in chess? Of course, if you want to lose, you can lose. It's an individual sport. Can you lose on purpose in football? You can. A bit difficult because you have to get your team agree to that fact that you want to lose this match, right? But can you lose on purpose in stock market? You cannot. If you made up your mind that today I'm going to buy the worst stock in the market so that I lose money, by the end of the day, you are up 10%. Because you don't control it. Right? And if you think that whatever you buy is going to turn to gold, you don't control it. You made the best investment, you bought the best stock available in the market, and it's down 10%. And I'm not talking about one day. Even in 5 years, the stock has not gone anywhere. I have so many experiences. I'm sure people who are investors here have had experiences where they think that 5 years back, I made a good decision. I bought a great stock. The stock is not doing anything. If you want to make the stock do something, just sell it. And that is where the stock starts rising. Jeff Bezos understands this idea of patience very well, right? And this is what he says multiple times, that if everything that you do and you want the results in the next 3 years, then you are thinking like everyone else. But if you're looking at a 7 to 10 year time horizon, which means the efforts that you're making now, and you want them to bear fruits over the next 5 years, 7 years, 10 years, then you are thinking unlike others, right? And Bezos also said that things are going to happen, right? Things that deserve to happen are going to happen. It's going to take a lot of long time. Do you have that kind of time or not? In the stock market, nothing may happen in the next 3 to 5 years. But by the way compounding works, if you have made the right investment, if you had the right temperament, if you don't interrupt that compounding machine for the next 10 years, 15 years, 20 years, and the longer your time horizon and the better the investment, you are going to create wealth from stock markets over a long period of time, right? And this is how you differentiate yourself from most other people. I'm not sure if you've read this wonderful book, What I Learned About Investing from Darwin, written by Pulak Prasad, who's a money manager from Nalanda Capital based out of Singapore. And they are the guys who are one of the rare investment team in the industry who buy and don't sell at all, right? And they have sold some of the stocks, but this is the list of 22 companies. They've not named the companies. One of the members of Nalanda Capital is Anand Sridharan, and Anand actually writes a wonderful blog called Buggy Human. And in one of the blogs, I think last year or a couple of years back, he did, without naming the name of companies, he just shared the track record of each of these stocks, 22 companies that they bought in 2012 and did not sell for the next 10 years. And the returns on an average were between 18% to 43% compounded annual rate of return for these 22 stocks, which they did not sell at all in the previous 10 years. During the same period, the Indian markets, because these are Indian companies, the Indian markets returned 12 to 15% annual average return just by doing nothing. And this is what Anand wrote in his article. Over a decade where most investors struggle to beat index, total inactivity would have delivered top decile performance. Had God revealed this future in June 2012, I would have cancelled Bloomberg and completed my bestseller, Indolent Investing, from a nice beach. The only condition, he says, to realize all this awesomeness is we do almost absolutely nothing. Nothing. We equate stock market with activity. This is what we think. Stock market, if you are going to be a stock market investor, you should be looking at the stock screens on a daily basis. You should be looking at stock prices on a daily basis. This is, I'm sure people in this room don't believe in that thing, but this is what the general audience believes in, that if you are going to be a good investor, you should be very active in the stock market. But if you look at the best investors out there, over multiple decades, I'm not talking about the last 10 years, but over multiple decades, these are those investors who have been in the stock market, but most of the time they have not done anything. They have bought great investments. They have held on to those great investments over a long period of time. That is what has created the most amount of wealth for those investors. The problem is that we are not willing to learn from that because that sounds so simple, right? If you go to a doctor, and this is how we behave. If you go to a doctor and you are suffering from some mild flu and some cold, and the doctor says, do nothing, go home, sip warm water, relax, no medicines. And he says, I want $500, right, as my fee. And you say, for what? You've done nothing. On the other hand, if a doctor gives you an antibiotic, a painkiller, right, a medicine, 5 or 6 different medicines, then you think that the doctor deserves a $500 fees, right? Because we equate activity with achievement. In medicine, it happens, right? You go to a doctor for something, and probably the next day you're on the operation table because the doctor has to justify his fees or her fees by acting on things. Whether it's healthcare, whether it's investing, the less active you are, the better off you're going to be over a long period of time. And this is what Nalanda's Capital, Pulak Prasad that I was talking about, approach to investing. 3 things. Avoid big risks, which means don't invest in something that can kill you. The second is buy high quality at a fair price, which means always focus on high quality investments. And the third thing is don't be lazy, be very lazy, right? This is what his team did. 10 years, 22 stocks, no selling, just they bought those stocks and did not do anything. And they outperformed the markets by a far margin. Of course, one of the reasons is that you need to buy high quality. You cannot just buy anything and think, okay, I'll not do anything. I'll retire on the beach after 10 years. Nothing remains. You have to buy high quality. That's the first thing. Equanimity. Now, how many of you like philosophy? Very few people. Right? I talk a lot about philosophy, and I'm sure you must have understood by that. It's less about investing and more about how to become a good decision maker and how to live a peaceful life. Right? So, in Gita, in Indian philosophy, there's a concept called samatvam, which is sameness of the mind. Sameness of the mind, and this is what Rudyard Kipling also says, right? When the world is going topsy-turvy, if you can maintain yourself, maintain your mind as calm and composed, you'll be a man, my son, right? This is what he said. Triumphs and disasters, they're 2 imposters, right? Bull markets and bear markets, they're 2 imposters. They're in front of us on a daily basis. But how do you survive the markets up and downs? How do you survive the good and the bad cycles over 20, 30 years? By maintaining evenness of mind. There's a story about the king who sent his courtier to find those 3 or 4 words that are true across, or a sentence that is true across all life situations. And that courtier roams around the country, meets the wisest people around, and comes up with 4 words which are true across all situations. And that sentence is, these too shall pass. Everything passes, right? In stock markets, you have bear markets, you have bull markets, you have bull markets, you have bear markets. Everything passes. And this is how, if you really believe that over a long period of time, if you can keep yourself, if you keep your mind sane, right, and same right? You're going to do really well. You're going to survive. Investing is not a finite game, right? Now, there's another concept of finite versus infinite games that we play. What are finite games? As the name suggests, those are the games which have an ending, right? A game of football, a game of cricket, for example, a game of chess. Finite games. There has to be an ending. Most of the time, someone has to win, someone has to lose. All the other things in life, including investing, are infinite games, where there's no ending. There need not be a winner. If you have to win, does not mean someone has to lose. And if you lose, does not mean someone else would have been winning. We can all win together. And if you believe that, then you're not going to get troubled by the ups and downs that the stock market forces upon you. If you believe that everyone can win, right? Most of the time, the problems that we suffer and the mistakes that we make in investing are caused by our own mindset, right? You've heard of greed and fear, right? This is what drives stock markets, greed and fear. Munger says that there's a bigger enemy within us, bigger than greed and fear, and that's called envy, right? Man is not rational. We all think we are rational beings, and Munger says it rightly. We are not rational beings, we are rationalizing beings. So after an event has occurred, we rationalize that. It must have been bad luck, right? I made a mistake, right? My bad luck, all those kind of things. Peter Lynch, one of the greatest fund managers of all time, Magellan Fidelity fund manager in the 90s, he wrote an article called Use Your Edge in 1997, where he gave an example of a stock called Microsoft, right, which came out with an IPO in 1986, so 11 years before Peter Lynch wrote this article called Use Your Edge. And he showcased that in those 11 years, since the time Microsoft came out with an IPO, if you had bought that stock any time, or especially in the late part of 1990s when the IPO had just come, you could have multiplied your money 100 times. And if you had bought any time during the previous 11 years, it was a simple business for people to understand. Microsoft was selling just simple software products, Windows products, right? Of course, sounds technical, but then, okay, one company, one product kind of a stuff. And he used it to explain that if you buy good quality business at any time, you can make a lot of money. And this is what we understand, right? Investing is about buying high quality businesses. This is what I'm talking about as well. You could make a lot of money, right? This, by the way, is the stock price chart of Microsoft. During 17 years, from December 99, which is the peak of the dot-com, nearly the peak of the dot-com boom, for the next 17 years, investors in Microsoft who held onto the stock earned nothing. Where is long term? Now, one excuse to this argument is that, of course, there would be very rare number of people who would have bought at the peak and held on for 17 years. Most of them would have sold here or here or here, right? Nobody holds on to stocks, especially when they are not giving any return for 17 years, especially when you're losing money. But even if you have held for long term, 17 years, you would have not made a single dollar, single percentage of money in a high quality business like Microsoft. Long term, right? And then this happens. Now this is that long term. When 17 years you lose hope, you don't make anything. And then in the next 4-5 years, you make a 16% annual average return from here till here. So this is 16%. It happens the last 5 years. Now how do you know? When is that cycle going to turn? When is that long term going to end and you're going to really make money in the stock markets? How do you know? Even if you're the most diligent of investor, how do you know? And Microsoft has been a great business. Of course, the reason of buying Microsoft in 1998, 99 was different. It was Windows software. They lost the plot in tablets, in smartphones, everywhere they lost the plot. And when they got the plot right, this is what happened. But how do you know whether you should be buying Microsoft more, you should be selling Microsoft, you should be holding Microsoft, and you should be not doing anything and probably buying here to see the rise, because this is a huge rise, huge wealth created by Microsoft in the last 5 years. And even if you were an owner of the stock from this peak till now, you would have earned a 16-17% annual average return, which is a great return over 24-25 years of not doing anything. Now, how do you know that you should have not owned Microsoft, and buying reasons for buying Microsoft here was very different from here? This is what is all about process. How do you look at investments? How do you look at businesses? Right? In Gita, there's a saying called karm karo phal ki chinta mat karo. Karm is action. Phal is the fruit. Right? Do you control the fruit? Do we control the outcomes? The Gita says no, we don't control the outcomes. But do we have some control on the karma or the action? Of course, we have a lot of control on the karma and the action. Right? So if we can apply the same rule which was said by Bhagwan Krishna to Arjun on the battle of Mahabharata centuries and centuries back, and the same rule apply to investing as well. All you control is the process, you don't control the outcome. Right? If you have a good process, you will have a good outcome in the long run. If you have a good process, you may have a bad outcome. That's a bad break. If you have a bad process, you can still have a good outcome in the short run. That's dumb luck. And if you have a bad process, in the long term, you will have a bad outcome. So all you need to focus on is a good process, then expect to be deserving to receive a good outcome in the long run. And investing, as I mentioned, is not just a game of skill. Knowing how to read financial statements, picking the best kind of investments, it's not entirely that investing is all about. Investing is also largely a game of luck. Right? As Buffett says, he won the ovarian lottery to be born in the United States at that point of time. We probably all won the ovarian lottery to be able to afford to invest. And not born in a country where there's no stock market or probably there's war and strife and everything. So now that's not your skill. That's your luck. Or probably I started investing in 2003. This is where I got my first job. Straight out of college. And that was the start of the bull run, the best bull market India has ever seen between 2003 and 2008. The stock market as a whole multiplied by 7 times in that 5-year period. And by the 5th year, if you are an analyst like me in the stock market and everything is rising, you start thinking that you are a master of the universe. Everything you research, everything that you recommend as a stock turns to gold. You think you know everything. Because that time you don't know about the Dunning-Kruger effect. And you don't know about the Planck's knowledge versus Schoffer knowledge. In hindsight, you know all those kind of things. But we all suffer from the syndrome of not giving luck its due credit, like this person who won the Spanish national lottery somewhere around 2001, 2003. And he won 1 or 2 million euros in the Spanish national lottery. And when you win a lottery, which is the biggest lottery in the world, you're going to get interviewed by newspaper and media. People think that you are smart. And people were asking this guy a question, okay, how did you manage to win such kind of a lottery? As if he knew the secret. And this guy knew the secret. And they realized that this guy was looking for a ticket, lottery ticket with the last 2 digits as 48. Of course, this is not the actual ticket. I found a ticket with the last 2 digits as 48. And they asked him, why were you looking to buy a lottery ticket with the last 2 digits 48? You bought the lottery ticket, you won the lottery ticket. What's the secret? And he said, I wanted to buy the last 2 digits 48 because for the previous 7 nights before buying the ticket, I saw the number 7 in my dreams, and 7 into 7 is 48. I went and bought the ticket. Isn't that my skill? In stock markets, we behave the same way. We think 7 into 7 is 48. And when we actually get 48, we think it was our skill. Not realizing that it was pure luck. That 7 into 7 turned out to be 48. And you got lucky. Nassim Taleb is one of the great writers currently. He talks about the idea of Russian roulette. Russian roulette, as you can see, this is Russian roulette. You have a gun, you have 6 chambers, 1 bullet, 5 empty chambers. The probability of surviving is 83%, 5 upon 6, because there are 5 empty chambers. There's only 1 bullet, you don't know where the bullet is. Would you play this game if I were to offer you $1 billion? I don't have $1 billion, but if I were to offer you $1 billion, would you play this game? Anyone who wants to play this game? The answer would be different when I'm talking to an 18-year-old. Why not risk it for the sake of $1 billion? Why? And they'll give you mathematics. They'll tell you what the probability of surviving is 83%. But the consequence of not surviving is that you become a statistic. And people are going to make fun of you. This is the guy who played the Russian roulette and died. Now in Russian roulette, we know the probabilities. There are 6 chambers, 1 bullet. The probability of surviving is 5 upon 6. But in life, do we know how many chambers are there in the barrel of reality? And do we know how many bullets are there? We don't know. So how do you calculate the probabilities? So we play the Russian roulette in the stock market, or the investors or decision makers in life as well. We take one decision after another thinking that since the bullet is not hitting me, it means that I must be doing something right. People consume alcohol, people consume enormous amount of drugs, people speculate in the stock market. They play aggressive games where they know that they can get killed. But since they are not getting killed while playing the same game, they think that there's no bullet. But the problem is that because you don't know the number of chambers, don't know the probability, after a certain number of hits where you survive, you forget that there are bullets that are going to come to you. And that is the idea of luck versus skill. If you are successful in the short run, and if you keep getting successful because the markets are rising, you think or you forget that there are bullets of a bad market, of you losing money permanently, that's going to come and hit you sometime in the future. But because you think that because you are rising in life, and if you're a duck in the pond, and if you're rising, you think that it's your skill. No, it's a pond which is rising. It's also a matter of huge amount of luck. Markets are rising. Right? So remember the idea of Russian roulette. Remember the idea of not playing the game. Stock markets are like open outcry auctions. In auctions, the winner is the loser. Right? Because the winner has to pay a price, a multiple of what that thing actually is valued for. So how do you avoid playing the open outcry auction? You simply don't go there. Does not mean that you don't invest in the stock market. It means that you don't buy bad businesses, you don't overpay for stocks. Right? Humility, the second concept, patience. Now, humility does not mean that you think of yourself as less. I don't know anything, right? I'm not aware of anything. Humility, the idea of humility is intellectual humility. The idea that I talked about, the more you know, the more there is to know. Right? Look at this chart. Various variables that determine our investing return over the long run. You have risk, how much risk that you take, how much cost that you incur, how much time that you spend and have, and how do you behave. And the fifth variable is return. Now what we control is the risk, the cost, the time, and how we behave. We don't control the return. This is the action, this is the outcome or the fruit of the action. We don't control it. Ironically, we rarely focus on things that we control, and we almost always focus on things that we don't control. Does it happen with you guys as well? Does it happen in Thailand stock market where people are chasing returns? I'm sure it happens everywhere. We are all humans, we think alike. Geographies are not, we are not dependent by geographies. India is probably 99% speculators. I'm sure the same number is for Thailand. I think that does not apply to people in this room. Sherlock Holmes, the best part of our knowledge is that which teaches us where knowledge leaves off and ignorance begins. Know the boundaries. Circle of competence. What is circle of competence? Circle of competence. The idea is not to be competent at a lot of things. The idea is to know the boundaries that you should not be crossing. Now, if you are drunk and if you're driving, it's like the game of Russian roulette. And you survive and you reach your home. Was that a good decision? The outcome was fine. You reached home safely. And you're going to repeat that tomorrow. And you reach home safely. Third day, safely. You forget that that bullet is going to come to you someday. Because we forget the role of luck. We think it's our skill. All decisions that we take in life and investing, it's a combination of luck and skill. It's rarely only about luck. It's rarely only about skill. And same with investing. Successful investing requires Arrogance. Now, what is it, arrogance? Arrogance is a negative term. But you have to be arrogant to understand that if you are buying a stock or investment, you know something more than the person who's selling it. Or if you're selling a stock or investment, you need to be knowing more than the person who's buying it. So that's the only arrogant part of it. But it also requires huge dose of humility to understand that you may be the party who's wrong. Or you are the person who may be committing a mistake. That humility has to be always there if you really want to survive the next 20, 30 years. And the most important skill in investing is survival. If you can survive 30 years, you're going to create a huge amount of wealth. Most people don't survive. Diversification, right? Now, this is where I disagree a bit with Warren Buffett, who says diversification is the protection against ignorance. It makes very little sense for those who know what they are doing. Most of the time, we don't know what we are doing. And that's the reason we need to have eggs in different basket. Not too many baskets, like Peter Lynch says. Instead of diversification, it does not become diversification, W-O-R-S-E. It should not become like 50 stocks, 100 stocks, multiple investments, real estate, stocks, mutual funds, everything, not all over the place. But you need to be humble enough to understand that even if you are the best investor out there, you sometime or probably you often have to diversify a bit to protect yourself when things go bad. Because most of the times, we don't know what we are doing. In most things, the idea of circle of competence, it's very important for us to know what we don't know. And as I mentioned, the size of the circle does not matter. And this is the amount of thing that you think you know, but this is the amount of thing that you actually know, including in investing. And the size of the circle does not matter. What matters is you should not cross the boundaries and go out of it. And we generally don't do it in real life, but we do it in investing. And when I go to India, when I look at Indian investors out there, all doctors want to buy tech stocks and all techies want to buy pharma stocks. Because the grass is always greener on the other side. Or the grass is always greener on the side which is not mine. And this happens everywhere. Something happens in the stock market that we think that we know everything. It doesn't happen in real estate investments. And there's a differentiation we all know of. We don't buy and sell real estate on a regular basis, but we buy and sell our stocks on a daily basis. And the simple, of course, one of the reasons is liquidity and the size of investment. But a very important answer or differentiation is because the real estate prices are not coming to us on a daily basis, but the stock prices are coming to us on a second by second basis. That leads us to act on a second by second basis. Which is not what good investors do. Howard Marks, I think you guys had him in Bangkok some time back, right? Howard Marks, he's one of the legendary investors. He talks about this 6 foot tall man who drowns crossing the stream that was 5 feet deep on an average. The guy is 6 foot tall. How can you drown in a stream which is only 5 feet deep? Because it's 5 feet deep on an average. Now you don't need to survive on an average in the stock market. You have to survive on a daily basis. You cannot say, I will do good in the bull market and I also survive at the bad market. You have to ensure that you survive the bad markets as well. You have to ensure that margin of safety. You have to ensure that you buy good investments. You have to ensure that you don't interrupt your compounding machine. You have to ensure that you pay the right amount of price. And you have to ensure that you stay in your circle of competence. You cannot change your attitude and your mindset with change in market situation. In bull market, you can go outside your circle of competence. You can overpay for stocks. In bad market, I'll take care of it. No, you cannot take care of it. Then you'll be like that 6 foot tall man who drowns when you meet a bad market. And there are no laws in investing. That's the best part. And that's the reason it's called a liberal art. And that's the reason as you mature as an investor, you realize it's less of science and more of art. Because there are no laws. Things which are cheap can get cheaper. I'll just give an example of a company called Suzlon, which is a wind power company in India. And things which have gotten expensive can get even more expensive. So you cannot simply say that the stock is already down 90%. How much more can it fall? Now look at it another way. If a stock is down 95%, it first fell 90%, then it fell 50%. And how much more it can fall? It can fall another 100% to go to zero. I'm sure a lot of stocks have gone to zero. A lot of big companies across the world, in India, US, I'm sure in Thailand as well, big companies, well-known names have gone, just disappeared and lost everything for investors out there. Where at some time, people thought that nothing could happen to this company and it's gone, disappeared. No ironclad laws. And that should keep us humble as well. How many people with very high IQ in this room? I'm not raising hand, I'm asking you to raise your hand. Well, humble guys. And that's good. Because the moment you combine your intelligence with a lot of money, that's a disaster. The biggest crashes and the biggest fiascos and the panics and market disasters, economic disasters have been caused by the most intelligent people in the world. Whether you talk about the 2000 dot-com bubble and burst, whether you talk about the 2008 financial crisis, of course not the 2020 epidemic, maybe. But the moment you start thinking that I know it all, be prepared for a disaster. I call the stock market a great humiliator. Because the moment I start thinking I know it all, it humiliates me. Right? I'm certain this business is going to do well. Let me buy more of it. I'm perfectly fine overpaying for this stock because I know this business has a great future. Right? I know that the market is crashing, they're going to crash more. The moment you think that you've figured it out all, right, you are going to get humiliated. And even otherwise, even if you're perfectly fine, perfectly sane, and you are a good investor like I see people in this room, you're going to get humiliated from time to time. And the biggest secret of investing, as I mentioned, is to survive over a long period of time. Now, if you understand that you're going to get humiliated by the stock market, you'll ensure margin of safety, you'll ensure circle of competence, you'll ensure buying high quality investments, you'll ensure long-term compounding. Because you need to survive that humiliation. This is a pie chart of a track record of an investor called Prashant Jain. So he was a money manager who retired from money management in a mutual fund. He started his own money management firm now. But he was a mutual fund manager in India, one of the best mutual fund managers in India ever. 30-year track record of delivering 20-25% annual average return for shareholders in mutual fund, which is 20% over 25 years is 100 times your money. Right? And he's done really well over 25-30 years. He hung his boots recently and he revealed, he wrote a letter to everyone out there who was willing to read it. It's a wonderful letter talking about the experience of a money manager for 30 years. And he's mentioned that of all the stocks that he's owned in his 30-year track record, 69% of those stocks were winners for him, that they earned him money. There were 5% that were really big winners. There were 1% that lost him big money. And there were 25% that lost him some money. But he also mentioned that his big winners of 5% were enough to take care of all the big losers and all the losers out there. So this guy had a 74% track record, 25 plus 1, 26% of his stocks lost him money. He did well for 74% of his stocks. How can you aim, or how can we aim for having a 100% track record in the stock market? Everything I buy turns to gold. No, it does not happen. For the best of investor, it was only 74% of his stocks did well for him in terms of earning him return. But he also ensured that he had a very small number of big losers. Of course, that was in hindsight. And this is what Charlie Munger says. A lot of success in life and business comes from knowing what you want to avoid: early death, bad marriage, bad investments. And investing or decision making is not only about taking positive strides. You also need to avoid the disasters. You should not aim to go 1 step forward and 2 steps behind. How do you avoid disasters? Margin of safety, circle of competence, high quality business, patience, humility, rationality. They don't teach you these things in MBA schools. How many of you are MBAs? Unfortunately, I'm an MBA. You don't learn these things in MBA schools. You're taught capital asset pricing model. How many of you understand capital asset pricing model? How many of you don't understand? Everyone understands? People who don't understand, good. Because it doesn't work in real life. It's a measure, it's a method, mathematical method to calculate the risk in an asset. Right? So if you can calculate that number, you can find out whether that asset is risky or not. But the real risk in investing is not dependent on a number. The real risk in investing is losing your money permanently by investing in a bad business. The real risk is not meeting your financial needs when you don't have money coming in. That is a real risk. And of course, the real risk is also losing opportunities when the markets are down, everyone is selling, right? And you have opportunities, but you don't buy because you think, oh, markets are going to fall even more. Let me wait. You are missing opportunities. That's also the real risk. It's not a number. But people equate, especially people who are trained in management schools, they equate stock prices jumping up and down as a risk. A stock falls 10% today, oh, the stock is risky. The stock rises 10%, the stock is less risky. Doesn't happen that way. A stock which falls 10%, 20% does not make it risky. A business that goes down and does not recover and loses money permanently for the investors, that is a risky business. We need to avoid those businesses. Now, this is not a financial analysis class and I don't want to trouble a lot of you, right? But there are simple ways of assessing which business is risky and which business is not risky fundamentally. You cannot say anything about stock prices, but you can say something after analyzing certain business. Okay, this business, these are 5 numbers which I'm looking at. Good return on capital. The balance sheet does not have a lot of debt on the balance sheet, right? The managers who are running the business have done really well for the last 20, 30 years, not for the last 6 months or 1 year. These are like experienced managers who are managing the business. Very important, integrity. And there's this hiring policy of Warren Buffett where someone asks him, how do you hire people? What do you look at in people? He says 3 things. The first is energy, the second is intelligence, and the third is integrity. And the other person says, that's it? No. If the third is missing, the first 2 are going to destroy that person. So the integrity is missing. Even if the person is high energy and high intelligence, I'm not going to hire that person. So the most important thing for me is integrity. In the same way, when you're looking at managers to invest in, don't go with the most high-flying management teams or high-flying companies. And why do we do that? Most of the time, we equate investing with optimizing for the best returns. I want to invest in the company which should give me the best return. No. Personally, for me, and that has kept me sane for the last 20 years investing, is that I don't optimize for returns, I optimize for happiness. Now, how do you optimize for happiness? You want to partner with managers whom you are happy partnering with. These are high quality, clean, high integrity people. They may not be the biggest high flyers in the industry. They may not be able to compound my capital at 25%, 30%. They're going to do better than inflation. They're going to do better than 15%, say somewhere around 20%. They keep paying dividend or no dividend, that's perfectly fine. But they're ethical, good people. This is the kind of friends I want to have in life. In the same way, these are the kind of managers I want to have in my life. But people forget that in bull market. And that's the reason I'm reminding you, don't forget, because we are in a bull market. So, making positive strides, but avoiding negative outcomes. And Munger also says the secret to survival, and he has a quote where he says, all I want to know is where I'm going to die, so I will not go there. If I know something is going to kill me, like Russian roulette, I'm simply not going to go there. Even if the probability of survival is very high, but the consequence of failure is destruction and death. You simply don't go there. I'm going to read out a passage from Warren Buffett's 1989 letter. So he owns a company called Borsham. This is a high-end jewelry business. And Hari, you should remember this. Right? Yasmin is listening. He's going to Omaha. Borsham. Right? So Ike Friedman is the founder of Borsham, and this is a story dated 1989, where they had just bought Borsham as a stock, as a business. And this is and Ike Friedman, they all collected at a place, right, where Borsham had to showcase the jewelry, and all the investors in Borsham and Buffett, and they were all at a place, right? And this is exactly what he writes. Ike Friedman of Borsheimer is not only a superb businessman and a great showman, but also a man of integrity. We bought the business without an audit, and all of our surprises have been on the plus side. If you don't know jewelry, know your jeweler. It makes sense whether you are buying the whole business or a tiny piece of diamond. Now, every 2 years, I am part of informal group that gathers to have fun and explore a few subjects. Last September, meeting at Bishop's Lodge in Santa Fe, we asked Ike, his wife Rose, and his son Alan to come by and educate us on jewels and the jewelry business. Ike decided to dazzle the group, so he brought from Omaha about $20 million of particularly fancy merchandise. I was somewhat apprehensive. Bishop's Lodge is no Fort Knox, and I mentioned my concern to Ike at our opening party the evening before his presentation. Ike took me aside and said, "Do you see that safe, Warren? This afternoon we changed the combination, and now even the hotel management does not know what the lock combination is." I breathed easier. This is what Buffett says. And Ike went on. He says, "See those two big fellows with guns on their hips? They'll be guarding the safe all night." And Buffett says, I now was ready to rejoin the party. But Ike took me aside and he leaned closer and he said, "And besides, Warren, do you know? The jewels are not in the lock." Right? So Ike actually had a lock with two guarding people, right? So that everyone believes that the jewels are contained in the lock, but the jewels were not there. The idea is not to calculate how much risk you're taking. The idea is to not take any risk at all. This is a very important lesson from Ike Friedman. The third important idea that I was talking about is rationality. Munger says we have a high moral responsibility to be rational, though he says we are not rational beings, we are rationalizing beings. I made the stock market prediction in 2024. I make the same prediction in 2023 as well, and every year. And my prediction is that markets are going to go up and down, and investors in general will behave irrationally. That's the safest prediction to make because that is going to come true. All other predictions except this one are not going to come true, right? So people are going to buy, sell, right? Do all those kind of things the entire year, and you'll be happy to make the right predictions. There's this book called Zebra in Lion Country written by Ralph Banger, and there's an anecdote which really I love. And he says, the stock market is like an excitable dog on a very long leash in New York City. It darts randomly in every direction. The dog's owner has done the same walk for years, starting at Columbus Circle, through Central Park, ending at Metropolitan Museum. At any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know he's heading northeast, which is the owner's direction, at an average speed of 3 miles per hour, which is the owner's speed. What is astonishing is that almost all of the market players, big and small, seem to have their eyes on the dog, which is the markets, and not the owner, which is the business, right? So if you have a dog and you take him or her for a walk, you know that wherever the dog moves, ultimately the average speed depends on your speed. The final destination depends on your destination, not the dog's destination. The dog is a stock price. You as an owner are the business. Right? Most of the people are looking at the dog jumping up and down. This is what I did with my advice. Lurching here and there. But this is going to mean that I want to take at an average speed. Hence proved. Rationality. Why we are irrational? Because most of the time in the stock market, we are not investing in the stock market. We are indulging in useless information. We are envying others making money. We are copying others' ideas mindlessly. We are fearing missing out. We are predicting future market. We are regretting past mistakes. We are avoiding accepting of current mistakes. We are denying reality. If time remains, we are investing. Right? Most of the times we are behaving irrationally in the stock market. If time remains, and this is for the very rare few people out there who actually invest in the stock market. Most people look at stock market as a casino, right? And when I teach students, I tell them the biggest difference between casino and the stock market is that in the casino, the longer you play, the more you are going to lose. In the stock market, the longer you play, the more you are going to win, right? People who understand it focus most of the time in investing. Of course, being humans, we are going to spend a lot of time here as well, but most of the time investing, which is studying businesses, right? Studying managements, buying high quality businesses and not focusing on the noise out there. This is not what most people do. And this is what creates the advantage. But as I mentioned, greed and fear, step aside, because we have a bigger enemy within us, which is envy. You have a happy man, right? And when you have a man's friend who is doing better than that happy man becomes suddenly, with the same trajectory in life, same wealth creation, same returns, same money, same car, becomes the unhappy man, right? People who earn salary, and this is my experience, right? You get a salary hike every year, and I used to get a salary hike that time in 2010, 11, that time. So I'm very happy with a 10% salary hike, right? Amazing stuff. It's much more than what I expected. But I suddenly realized that my colleague got a 20% salary hike, and that makes me the most depressed person in the entire company. Because we're always living life as multiplayer game. Life is not a multiplayer game as even Naval Ravikant says. It's a single player game. There's no win-lose. It can be win-win. But investing, as I mentioned, the biggest problem is that we are always looking at the other person. And when it comes to social media, where everyone seems to be becoming richer faster, right? The unhappy man is probably the unhappiest man. So, secret of happiness, avoid social media, right? Envy, cancer of the soul, it is actually, right? So the more you avoid it, and people ask me, how do you maintain sanity of the mind as an investor? Because you're surrounded with so much noise, so much information, right? I think noise and information to the mind is same as sugar to the body. And you know, sugar to the body is long-term poison. Noise and news to the mind is long-term poison. And how do you avoid getting poisoned? You simply don't consume it, right? Or you consume and you have, like Buffett says, if I were to talk about Buffett, he says, I read 10 newspapers in a day. So the counter agreement is Buffett is reading 10 newspapers in a day. How can I say that you avoid noise and news? Because Buffett has an ability of differentiating between what is noise and what is signal. Can you separate what is noise in a newspaper or a media and what really matters? If you can do that, go and consume media. But most young investors are not able to do that. They'll go to Twitter and Instagram and YouTube, and they're going to see videos of people making money faster. And now you also have people creating such videos of how I made a multi-bagger in the last 5 years. How is my portfolio up by 30%? And how easy it is to do it. And we all start believing that it's actually easy. Right? So Russian roulette on YouTube. The fear of missing out. A very common fear. We all fear missing out. And that's the reason we also attend sessions like this. Thinking that, oh, I may miss out on something special, secret that Vishal is going to talk about on stage. And when it comes to investing in wealth creation and money, we always suffer from this fear of missing out. And that's the reason bull markets are created. Because people are the most fearful, people who are the most fearful come at the near of the end of the bull market and they keep the prices higher. They're buying everything because they fear missing out on future potential gains. But if you have the sense of having enough money, if you have the sense of having earned enough return, the greater the sense, the lesser is the fear. Right? So this is going towards a bit philosophical side, but that's what investing is all about. It's not about numbers. Numbers is the easy part. Maths, Excel sheet is the easy part. Temperament and looking at investing from a liberal point of view, a multidisciplinary point of view, a philosophical point of view, the same lessons that applied 2000 years back, the same lessons we can apply today as well. If you know those lessons, you'll automatically become a good investor, a much more calmer and peaceful investor. And what investing ultimately is, it's a way to give yourself peaceful night's sleep. If something is not allowing you to sleep peacefully at night, including your investments, it's not worth it. Not worth it at all. Bull or bear markets. And as I already talked about that, optimizing experience over a long period of time. How I have created my investment life is that I don't focus on stock price returns, though I focus on good companies that may give me good returns, inflation beating returns over a long period of time. But that's not my core focus. My core focus of investing in business or investment I make, right, including of time, is to partner with people whom I'm happy partnering with. Nothing else matters. As you probably, I'm aging faster, but I'm sure people who have crossed their midlife crisis, right, who have crossed 40, 45 years of age, I'm sure most of us have been there. We realize that as you grow in age, all these things that we thought were attractive to us when we were 20, 25, 30 years of age are not worth it. Alpha. Alpha is a term used in investing where the amount of return that you earn, that you are able to beat the markets or beat the other investor. So you become an alpha investor. And people are all searching for alpha. But we also need to understand that most of the time, in most things that we do in life, they are going to be average. Right? This is a normal distribution curve. Right? This is how you lay down anything, like height of people in this room, the wealth of people in this room, right? The amount of intelligence of people in this room. If you equate them, if you put them in a normal distribution curve, there will be few people who are on the extreme right, the best among us. There are few people who will be the worst among us in terms of height, weight, net worth, everything, intelligence. Most of the people will be in the average. Now the society imposes upon each one of us to be on the extreme right hand side. Some of us probably end up here. But we never want to be in the middle, which is where most of us are going to be. The most important thing about having peaceful investing is that you accept that you may be here and you're fine with that. And what is average investing? Being average investing, you simply go and buy an index fund. How many of you invest in index funds? Are there index funds in Thailand? Yeah. In India, around 80-85% of the active money managers or people who are looking at stock markets or the smartest guys, they have underperformed the average investor, average fund out there, the average index fund. 80-85% of large cap, the big size companies, investors, the mutual fund managers, people with the highest IQ out there, they have underperformed a dumb index over 10 years, 15 years. Now, I'm not saying that everyone who's managing money is not an intelligent person who does not have the capability of investing money. There are people who are beating the markets as well. But if you are not a money manager, you're not a professional manager, you're managing your own money. And for you, the biggest incentive of managing money is that you create wealth for yourself, for your family, for your dependents, and you're able to survive for the next 20, 30 years. Your incentive is to not earn commissions and fees by managing someone else's money. The biggest responsibility or the biggest role that a money manager plays, right, is not to compound the client's money. It's to help the client survive the next 20, 30 years. When that client is going to need the money 20, 30 years down the line, that is the most important role of a money manager out there. The fiduciary responsibility that we talk about. Anyone can compound. Anyone can earn market beating returns in the short run. But there are very rare few investors who are able to survive or help their clients survive the next 20, 30 years. But if you go and look around in the market, you look at investment banks, you look at financial institution system across the world, they're all driven by short-term incentives. The client can take a walk. There's a wonderful book called Where Are the Customer Yachts? I don't remember the name of the author. But there's this investment banker who takes the potential clients to show, oh, this is my CEO's yacht, this is my secretary's yacht, this is my yacht. And the prospect asked, but where are your customers' yacht? Which means your customers have not gotten richer or what? Right? So when you are looking at money manager, right, don't get enamored by their yachts. Seek whether the existing customers have also made the yachts. And if you are managing monies for someone else, remember this idea of fiduciary responsibility. I'm sure you all are already doing that. And also as individual investors, it's perfectly fine being average. Aim for the stars. I'm not saying aim for being average. Aim for the stars. Try to do the maximum amount of hard work to buy the best investments and hope to get lucky over a 10, 15, 20 year time horizon. But be fine settling for an average, which is the market rate of return. Because on an average, we will be average. That's how numbers are. The happiness curve. You guys came for the art of investing. I'm talking about everything except investing. Now, this is a book. This is a wonderful book, Happiness Curve by Jonathan Roach, where he says in our 20s, right, we're probably the happiest out here because we have the least amount of stuff and complexity in our life. As we age, this is the age. As we age, this is the addition phase. We keep adding new stuff, new people in our lives, right? A lot of gadgets, a lot of stuff, new house, a bigger house, right? New cars, a bigger car, like foreign holidays, new MacBook, yeah, addition phase, right? So we think that every shiny stuff is going to make me happy. But there's something called as a hedonic treadmill. Hedonic treadmill, the idea of hedonic treadmill simply means that every time you think that something is going to make you happier in life, right? After that thing has come to pass, which means you've already received that thing now, your happiness is going to come down to your steady state. Same with tragedies in life. You think that people on wheelchairs permanently in their life, they are the unhappiest in the world? No. They are the same level of happiness, or they're probably happier than us because of hedonic treadmill. So it works in the positive, it also works in the negative. So we are in the addition phase, and because we are in the addition phase, we are always feeling inadequate. Oh, my friend has 30 stocks, he's earning 25% annual average returns, he's able to fund his son's or daughter's education, foreign education, right? He's doing so well in life. Let me also do the same thing. And you're earning a decent return. But you end up doing things because someone else is getting happier, richer, faster than you, and this is what you think. Right? This happens till you reach the midlife crisis. 40, 45 years of age. Where you have added so much stuff in your life that your happiness is at the lowest. And after say 40, 45, 50 years of life, when you are at that midlife crisis, you start believing and you start learning and you start reading scriptures and you start attending philosophical classes and all those kind of things, where you realize that most of the stuff that you've added in your life is not worth it. They have not given you eternal happiness that you thought they are going to give you. You are still the same person as you were when you were 25 years of age. And I thought this is the exact same journey I've traveled. If I can quit my job, if I can live my life on my own terms, if I can take my family to a foreign holiday, and if I can speak and people are willing to hear for 2 hours, I'll be the happiest in the world. I'm as happy or as unhappy as I was 20 years back because of hedonism. And then after you cross this phase, when you realize that it's not worth it, that's a phase of subtraction. You subtract negative things, you subtract negative people, you know it's not worth it. And because you subtract, you start feeling the idea of abundance, because you know that you have more than what is enough, the definition of enough, including enough returns or enough wealth. We are all going to suffer through this thing. I'm sure people have suffered through this thing. People who are less than 45, be ready. People who are 45 know that this is going to pass. And people who are beyond that know that it actually happened. Am I wrong? Am I wrong for people who have crossed the midlife crisis? How many of you are going through a midlife crisis? You're all there. This is what really matters in investing. So when you create a stock portfolio, the biggest stock portfolio in terms of the number of stocks are with the youngest of people out there. Because they think they know everything, whatever they pick is going to turn to gold. So let me pick 60 stocks because then you have 60 gold. But you have only 100% money. Right? So more does not mean better, including in investing. Ruskin Bond. Anyone who's known of Ruskin Bond? Ruskin Bond is one of the best authors. So he's a Britisher, but he lives in Mussoorie, in India's Mussoorie, right? In India. And he writes wonderfully. He writes about mountains. He writes some stories for children, which even adults can relish and enjoy. And he actually makes you feel that you are sitting next to him and he's reciting this. So my recommendation, go and read Ruskin Bond. In this book, Book of Simple Living, he says that if you owe nothing, you are rich. If you owe nothing, money doesn't make people happy, but neither does poverty. The secret then is to have as much as you need, or maybe a little more, and then share what you have. This is what he calls a rich life. Marcus Aurelius, Stoicism, he says, remember that very little is needed to make a happy life. Very little. And this is a story of Joseph Heller, who wrote this book called Catch-22. And he went to a party given by a hedge fund manager years back with another famous author called Kurt Vonnegut. And they were at a party at an island given by a hedge fund manager who was making a lot of money because the markets were in a high. They were bull markets and the hedge fund manager was making a lot of billions. So he gave a party and these two guys were friends. So they went there. And then Kurt Vonnegut tells Joseph Heller, do you know that our friend who's given us a party just yesterday earned more than what your novel has earned in its entire life? And Joseph Heller says, yes, I know that. But I have something that he does not have. And Kurt Vonnegut was surprised. How can such a rich hedge fund manager not have something that a poor author has? So what was it? And Joseph Heller says, I have the idea, the sense that I have enough. And that is enough for me. Now, what is real wealth? This comes from James Clear, written in the book, amazing book called Atomic Habits. Is real wealth is not about money. It's about not worrying about others claiming your time and energy. It's not feeling like you have to say yes. It's not having to go to meetings. It's not having to spend time with jerks. Some of you are doing that today, but that's perfectly fine. Not being locked into status games. Real wealth is about freedom. The freedom to do something. I was surprised when Hari said that your session was on a Monday. Is it a holiday in Thailand? Which means you all guys are free.
For him, we have to take another.
Yeah?
For him, we have to make sure we are free.
I'm sure. You guys are lucky to have him as a friend. I can say for sure. But this is what real freedom is about. Time, freedom of time. We all understand time is greater than money. But the time which you can choose, if you're free to do things that you want to do, with people that you want to do, at places that you want to do, and at the time that you want to do, that is what freedom is all about. But again, we all need to recognize that. The story about two friends, the monk and the minister. So they are childhood friends and they part their ways as they grow up. The first becomes a minister in a king's kingdom. The second becomes a humble monk with very few resources. And after 20-25 years, they meet. And the minister took pity on his friend who becomes a monk who has nothing, right? Who has very small resources. And he advises him. The minister is advising the monk. And he says that if you can cater to the king, you will not have to live on rice and beans. And the monk replies, my friend, if you can learn to live on rice and beans, you don't have to cater to the king. Most of the time, we are somewhere in the middle, in the monk and the minister. I think the idea is to be a bit that side. You don't have to cater to the king if you can learn to survive on rice and beans. Strujan's law. Strujan's law says that 90% of everything is crap, including today's session. So the law applies everywhere, right? So if 90% of everything is crap, the 10% still makes sense. And this is that idea that I think should make sense when it comes to investing, or most good things in life. Invest in good companies, do not overpay, and then do nothing. Invest in good people, right? Then do nothing. Because ultimately, as our scripture says, our actions determine our destiny. And this is wonderful saying from the Upanishad, which says you are what your deep driving desire is. As your desire is, so is your will. As your will, so is your deed. As your deed is, so is your destiny. It starts from the deep driving desire. If you have a deep driving desire to survive your wealth creation journey, to partner with good managements and good people, to be patient, to be humble, to be rational for the next 20, 30 years. And as Manga says, being rational is a great responsibility in an irrational world. If you can do that, because that becomes your destiny. And we don't get in life or investing what we want. I'm sure we all understand that. We only get what we deserve. So all we need to do is be deserving. And then we expect to get that thing, whether wealth creation or anything, over 20, 25 years, 30 years down the line, across the entire journey as well. Marion Seldes, the American actress, said something beautiful that I would like to quote. She said, and I quote, "The hardest thing to teach a student and the hardest thing to believe consistently is that there is nothing out there to go and get. There is no path, no career, no opportunity for which you should be searching and scourging and coveting. All of the preparation is within, and you keep yourself mentally and physically fit. You remain generous with yourself and others. You stay deeply in study about your craft. Whatever is yours will then arrive." Right? It takes time, but it's going to arrive. I like to end with a story from Dalai Lama. I heard the story, it's a version of Dalai Lama, it can be someone else, but it is apt. So there's this lady who takes his son, a young boy, to the Dalai Lama and says, "Dalai Lama, my son eats a lot of sugar. Can you please tell him something so that he stops eating because it's dangerous for his health. And the Dalai Lama looks at the son, the boy, and he says to the lady, please come after 3 months. And the lady is shocked because he didn't give any advice, and he says, come after 3 months. Okay, let me come after 3 months. Must be something. The lady takes the son again after 3 months to the Dalai Lama and says the same thing. If you remember, I came to you 3 months back and you asked me to come back 3 months later. Can you please do something that he stops eating sugar? And the Dalai Lama looks at the son and says, son, stop eating sugar. And the lady is angry. She says, you could have said the same thing 3 months back. He said, because 3 months back, the Dalai Lama says, 3 months back, I had to stop eating sugar myself. Right? So, my way of telling or whatever I have said today in terms of humility, patience, rationality, Munger, right, long-term thinking, circle of competence, margin of safety, is my idea of telling you to stop eating sugar because I have stopped eating that sugar many years down the line and it has benefited me. And I'm sure a lot of you are also not consuming the same sugar that I've talked about. Right? So wherever you're consuming more sugar in your life, whether it comes to investing or decision making or thinking, the idea of today's session was to guide you to stop doing that. Because over a long period of time, if you behave irrationally, if you're impatient, if you're not humble and you're arrogant, right, it's going to kill you financially otherwise. So with that, I come to the end of my session. I'll be happy to take any questions. I hope you found it worth of your time on a weekday, Monday afternoon. Right. So thank you so much. Thank you.
Thank you. Thank you for your wonderful presentation. Let's take a 10 minutes break. We'll come back for Q&A session.
Running off here. Okay. First of all, wow. Do you feel wow? Thank you. Yeah. Thank you. I felt like we didn't really have a chance to really celebrate what we heard there, so I just wanted to celebrate it because, you know, as we all get older, we start to realize true wisdom. And when I was young, I was chasing everything, but now I've started to see. Yeah, still young. Now, before that goes up, hopefully that's going to come back down. But
no more questions.
Questions are over.
No more questions, I think.
So for everybody, I know you have questions. And what I really want to encourage you to do is type your question in to the slide there that you can see. Scan the QR code. But if you don't have questions, please, it's coming back. Please go to the slide, go to the QR code, and upvote the question that you want answered. Because we're not going to have time to answer all the questions. So please upvote the question that you want to see answered, and that will help me to ask some questions. So while you are typing questions and upvoting questions, please let me start off by asking a couple of quick questions that I have, and then we're going to get to all of the audience's questions. So I took a lot of notes when you were talking. And, you know, one of the things that you said that I really appreciated was the idea of, I want to partner, you said, I want to partner with people that I feel happy with. Mm-hmm. And can you explain what you mean by that? When you think about investing in a stock, it's hard to think, particularly a publicly listed stock, yes, that you're partnering with this company or this CEO. How do you look at that, and how should we look at that when we buy a stock?
Great, I think. So there are three important variables when it comes to investing stocks. For me, I think in terms of priority, the most important thing is the business which I'm owning. The second thing in that list of three things is the management quality. And the third thing is the stock price, the valuation which I'm paying. Of course, all the three variables are very important. You cannot do away, and you cannot say I can buy a good quality and a good management at any price, right? Or I only look at the highest quality management, and the business could be anything, or the stock or the price could be anything, and I'll still be fine. For me, all those three things have to be tick marked yes for me to make an investment. But the reason I say that I want to partner with the right kind of people, I think my way of looking at that aspect is that when I'm investing in stocks, I'm not buying a piece of paper. I am becoming a part owner in a business, right? I'm buying a stake in a business, right? So if I think of myself as not a shareholder, but as a part owner in a business, right? For anyone who's running a business here understands the importance of a good partner, right? It's so important to have a partner with high energy, as I mentioned, high intelligence and utmost high integrity, right? So taking off that idea of Buffett of hiring people, if you apply that same idea of investing with managers who have high intelligence, who are very smart in their business, right? Who have high energy, which means they're always looking out for opportunities in their area of business. But the most important thing that they don't have a past, right? Because we are only studying the past, we don't know anything about the future, but they don't have a past where they have done something which is not ethical, right? Which is unethical, right? There's a very nice saying, I think, in a book called 100 to 1 in the stock market, is that a people or a person who steals for you in the future is going to steal from you, right? So if you are looking at managers are thinking, oh, I have not been an investor, even if he's done something unethical, I think this person is going to change. I believe that people don't change, right? So for me, business owners and partnering with the right kind of people is of great importance.
It reminds me when I was an analyst, I was servicing a client, Aberdeen, and they were very big on, the ethics and integrity. And I asked them once, how long before you forgive a company or a management team if they did a bad thing? And he said, about a generation.
Yeah, that's such an important thing.
One last thing from me, and then we're getting the questions coming in. Keep your questions coming and keep upvoting them. Sometimes when a super successful, super rich person gets up on a stage, they say, well, what would you do differently? And they say, I wouldn't work so hard. And I just get so annoyed with that because I feel like the whole success that they build was from working really hard. And when I see you, I wonder, in your earlier years, were you more frantic? Were you more caught up? Or have you always been this calm and rational?
I would not say rational because as I would completely agree with Munger that I'm still rationalizing a lot of stuff, right? But luckily for me, I have been a bit on the calmer side. A lot of investors, a lot of people I meet, right, they start from a trading mindset, they're buying and selling, and gradually they learn their lessons and they move into investing and Buffett and everything. Luckily for me, I don't know whether it's genes or whether by a stroke of luck, I've always been on the side of being an investor who's calm, who's not worried about daily volatility, who's patient, right? Though things have, I think, improved over a period of time. I would probably more impatient 20 years back than I am now, right? But I think I've been lucky over there that probably born with the right genes.
So temperament is an important part, I think, when you look at your character, and that's fascinating. All right, let's get into questions. We've got 19 questions so far, but look at all these smart people out here. I thought there was going to be a lot more, so feel free. Questions about life, questions about investing. But we have an upvote function, so if you don't feel like writing a question, make sure you've upvoted some questions. And the number one most upvoted question is an interesting one, and that is, what are your thoughts on gold as an investment? Do you own gold? Why or why not?
So my wife is not in the room and she hates this answer. We own, as a family, we only own gold which is for consumption, right? Not as an investment. Again, probably this is my learning through experience, and again, since I've been an ardent believer in what Buffett says, and I really believe, because I've tested on myself as well, I don't see gold as an investment, right? By definition, investment is something that generates cash. That generates cash flow. You can value that, right? For gold, of course, you can generate cash only when you're going to sell it. You cannot really calculate a discounted cash flow. You cannot really calculate the intrinsic worth of the yellow metal, as I say. But only for consumption, which I think is also very important for all the ladies listening here. Gold is a very important item that I think people should own, not as an investment, but don't think of it as an investment. Think of it only as a consumption item and not as an investment. So my view is consumption, not investment.
Okay, but be careful what you tell your wife about being consumption item, because they may want to consume more.
It's very important.
Okay, next question that's been upvoted 11 times is, Could you tell us more about the attributes or qualities that distinguish a good versus a great business?
Okay. I'm still learning, but I think my experience says that a good business or the great business, I think, so great, good and gruesome as I understand. A great business is one which leaves you with very simple questions to answer. You don't have to break your head to answer a lot of questions, right? In terms of the management quality, in terms of the business quality, in terms of the valuation. The answer has to be plain and obvious, right? So to equate with a savings bank account, for example, a great business is where you put some money in your savings bank account and it compounds over a period of time, right? Compound interest. A gruesome business is where you put more money to the account and that return comes down, falls down again, and because the business is gruesome. And a good business is somewhere in the between, which is the large majority of businesses out there, where the more amount of money you keep in the business or you invest in the business, you're going to compound, but not at a great rate. In terms of characteristics, I think a business which is managed by high quality people, a business that does not require a lot of capital year after year, a business that has a relatively clean balance sheet, right? So if I were to look at those numbers, these are attributes of a high quality business. Of course, management, keeping the management aside, but you cannot separate the management from a quality business. When I say I want to buy a high quality business and I also want to buy a high quality manager, I'm actually double counting. Because a high quality business over a 20-30 year time frame means that it was run by a high quality manager, right? So for me, it's as simple as that.
Also, so let's imagine a beginner here that's been following you and they go out and they do their search and they find that high quality business. You also talk about price. They find out, well, I'm not the first person to find out that this business is high quality. And then they find out that the valuation or the price of it is really high. What's their next step?
So there's a difference between, and this is something which I again learned from experience. If I were to go back 20 years back in my career, even 15 years back in my career, and people who are into stock markets, there's a concept called price to earnings. For every $1 or every 1 rupee of earning, there's a certain amount of price that you pay. So in my time, in the sense 15 years back when I was looking at stocks very aggressively as an analyst, a 20 time or a 25 times was supposed to be reasonably priced. Beyond that was super expensive. In today's world, because you have so much demand from new investors and very less supply of high quality businesses, that price to earning number has gone up to even 100 times for high quality business, which simply means for every $1, 1 rupee of earning, the stock is priced at 100 times. Now that obviously makes it very expensive. So I try to differentiate between overpaying, right, and paying too expensive a price. Now there's a difference. So I cannot really talk about mathematics because it's too short a time period to talk about mathematics over here. But I think as I look at businesses, something has to be obviously good, right? If I need to use the Excel sheet or the spreadsheet to decide whether the stock is good or not, whether the numbers are good or not, whether the valuation is good or not, I think I'm not making a right decision. If the answer is not very obvious that this is a clean management, the broader 5 most or 4 most important numbers have been reasonably good in the last 20 years, and the valuation is not very expensive, I can still start go and buy that, start buying that business at that point of time. But I also understand this idea of patience. When I talk about patience, it does not always mean that you need to practice patience after you buy the stock. You also need to practice patience before you buy the stock, right? Most of the times what happens is when we have completed our analysis of a business, we think that is the right time to go and buy the stock. But we need to separate the analysis from action. And this is something which I've learned by hard work and from experience by making a lot of mistakes. The moment you've done your analysis does not mean you need to go and buy the stock, right? That decision of buying the stock can happen only when the price is right. Your analysis is perfectly fine. It's like having a gun and waiting for a mammoth to come. You cannot start shooting in blind, right? Let the mammoth first come in and then you start shooting it, right? So separate your analysis from action, wait for the appropriate prices and then go and buy them.
And that raises a question that came in. It just came in and it hasn't been voted up, but they asked, have you ever invested in a company that you thought was a good business and you found out that it was a bad business?
It was. In fact, in 2006, I invested in a company, it was a hotel stock called Leela Venture. And Hotel Leela Venture or Leela is it was one of the biggest hotel companies in India that time. And I was at a property of Hotel Leela Venture in Bangalore, city of Bangalore, for a conference, and just loved the property out there. And I inquired, being an analyst, right? I went to the manager. I inquired about the bookings, about the prices for hotel, about the occupancy of hotel. These are the numbers that you look at. And for the next 1 year, the hotels were booked for conferences and tourism. The prices were the best or the highest in the industry, probably in Bangalore as well. And I instantly thought, okay, this must be a great business. If the hotel property is booked for the next 1 year, the prices are like exorbitant, still overbooked for the next 1 year, must be a great stock. And I went some part of that stock in my portfolio. The markets start falling and the stock also start correcting. In the next few months, the stock was down around 50-60%. And despite being an analyst, after the stock had fallen 50-60%, I picked up the annual report for the first time. And when I read the annual report, this is where I understood that a hotel business by nature is very capital intensive. What is capital intensity? Capital intensity is like a gruesome savings bank account where the more money you keep, the lesser is your return, because the business is burning a lot of cash year after year. There are a lot of such business. Airlines is one example where you have to put in a lot of capital, but the returns that you make over a longer period of time is almost zero to negative. Right? But a lot of people start airlines because that's a prestige issue. I own an airline. Right? It's a good prestige business to operate, but from an investment point of view, it's a horrible business because it's highly capital intensive. Right? So I have avoided hotel stocks generally. I have avoided any business which is capital intensive, because I know that, as I mentioned in my first answer, these are the kind of businesses that will leave you with a lot of complex questions to answer. And the moment it moves towards even slight complexity, I simply say no, I just move on to the next business.
Mm. And one of the things when I teach about valuation, we do free cash flow.
Yeah.
And some students will say, why do we do free cash flow? Everybody uses PE. And I say, well, because you can get a picture of the investment needs.
Yes.
What do you see, or what are the tools that you use to understand if this company is going to be consuming a lot of capital, or as you say, could potentially be a gruesome experience?
That's right. That's right. So I do a free cash flow analysis, a DCF, but I think it's more of a back of the envelope kind of a thing, right? So not literally back of the envelope. So I use the basic Excel model to do that. But more than the free cash, so the concept of free cash flow, for people who don't understand it, it's a cash flow which remains after all the important needs of the business has been taken care of, and that's the reason it's called a free cash flow. So the value of a business is all the cash that the business is going to generate over the next 10, 15, 20 years, and you have to discount that to the present value because you have to make a decision today. Right now, the flaw with a discounted cash flow model or any valuation model is that you have to look into the future. Now you cannot look into your own life's future. Now you are looking at a company which is changing on a daily basis. You are predicting the future cash flow using an Excel spreadsheet, and you say this is the value of the business, and you are bound to go wrong. Right? As there is a saying that the best software for writing fiction is not Microsoft Word, it's Microsoft Excel. Right? You use Excel to create the best fiction out there, and people do that as analysts. Right? So to avoid doing that, I use something called as a reverse DCF. Now what is reverse DCF? I look at the current stock price or current market cap, right? And then I try to change the growth numbers, the cash flow growth number, to arrive at a DCF value which is same as the current market cap, right? Now what that reverse DCF tells me is what is the stock market expecting the cash flows to grow at over the next 10-15 years to justify the current market price. If that expected number is 30-40%, the stock is obviously expensive. If the number is 10-15% or 20% in India, which is a growing market, I think the number is reasonably priced. So if I get a stock where the market is expecting a 10-15-20% growth in cash flow to justify the current market price, then I don't need to look at anything else. That makes the stock obviously reasonably priced, or obviously expensive, or obviously cheap. A lot of people, especially people who are analysts in the finance industry, we know something called as the target price, right? We've heard of the word called target price. Now there's no target price because the stock is not a static picture. It's a movie which is unfolding on a daily basis. You cannot have a target. And the funniest part of it is that when an analyst writes a stock report with a target price, they will not give a target price of 1,000 rupees or 1,500 rupees. They'll say 987 rupees. They'll say 1,023 rupees. Why? Because the more imprecise it is, right, the more money you can charge as fees, because the person says you've done a perfect homework, you've arrived at a perfect target price. But when you're looking at businesses, I think valuation is completely approximation and it has to be a range of outcomes. For me, when I'm looking at a business to buy, when I do a reverse DCF, I would, instead of saying, if the stock is say 100 rupees, I will not say the target price for the stock is 120 rupees. I would say the intrinsic value of the business lies somewhere between 50 rupees to 150 rupees. And if the stock is 100 rupees, I'll simply go and buy that stock, if it's a good business.
So the implied growth is such a great tool that he's just told us about. And I love the simplicity of the way you look at it and the idea of ranges, you know, that there's just no exact answer. But we are needing answers from you, and there's more questions. So here's one. If one foresees a recession looming, what kind of assets or businesses would one want to own?
First, stop forcing, right? That's my answer. Don't foresee a recession because nobody is able to predict a recession, right? It's very important to differentiate between, and we look at recessions as risks to a portfolio. I think it's very important to differentiate between two ideas, which is risk and uncertainty, right? Risk is something that you can measure, and risk is you, yourself, your behavior, your temperament, the kind of businesses that you own. That is what creates a risk in investing. Uncertainty is something that you cannot measure, because that's the reason it's called uncertainty. And all recessions are uncertainties. I think there's a saying, there's someone who said that the best economists in the world have been able to predict 9 out of the last 1 recession. So they have predicted more recessions than actually happened in the world, right? Don't do it, right? But if you are forcing, for example, if you think that the markets are too much in the overbought zone and the stock price is expensive, right? I would not say that you sell your stocks and you sell your investments and come out of the market, because there's no way you can time the market. As I said, there are no iron rules in investing. Something which is expensive can become more expensive, and it's cheaper can get more cheaper. You don't know when that tide is going to turn. My idea is to just keep owning high quality businesses without even doing the hard work of projecting a future recession. A couple of years back, I did some basic analysis on some high quality businesses in India, which if someone had bought at the peak of January 2008, before the financial crisis actually came to pass, and the prices were highest in January 2008 that time of the best quality businesses, and you bought that time at the highest prices, and you held on for the next 12-13 years, the minimum annual return would have been 23%, right? On the other hand, if the crisis actually came, so January 2008 to March 2009, we had the worst financial crisis in the world since Great Depression. At the bottom of March 2009, when the stocks had already fallen by 90%, and he bought the worst of businesses, bad quality businesses, thinking that they've already fallen 90%, how much more can they fall? The best return that you would have earned the next 12 years was minus 20%. Annual average return, which means after 90%, they fell another 90%, right? So if you own high quality businesses, you forget about any market crisis, any recession that is going to come, because you have no idea when it's going to come, and you don't want to be out of the market. If you are out of the market, there's numbers out there for every market. If you are out of the market on the 10 best days, right, you would not earn any kind of return, right? But if you want to participate on those 10 best days, you also have to participate in the 10 worst days, right? Which simply means you have to be a participant in the stock market if you really believe in the next 20-30 years. Otherwise, you should not be in the stock market anyways.
Brilliant answer. And could we interpret that to mean, if the person who's asking this question, you're worried about a recession, that maybe the thing is to continue to get cash out of your business, out of your life, and then wait for a recession to happen and increase your stakes in high quality companies?
I think that's a good idea. So instead of selling, you probably can postpone buying till you find valuations to be appropriate. So as I mentioned, 3 things: business, management, and valuation. You also need to get the valuation. I would not say right, but you also need to get appropriate valuation if you want to make or create wealth from stock markets, right? So wait for that.
And, one of the things that I can see from everything I've experienced about you is you've read a lot, you've absorbed a lot. And nowadays, it's hard to read books, it's harder. People read less. But this question is, what are your favorite books? And so I wanted you to think about what would be, if really 1 or 2 that you feel like somebody would be really worth the time for someone to read. Okay, so
there are a lot of books. Again, I have slowed down my reading over the last few years. I read probably much more 10, 15 years back than compared to what I am reading at this point of time. Mostly I'm rereading the same books which I have read almost 10, 15 years back, and I think that's an annual ritual. So one of the most important books that I recommend anyone and everyone to read on investing, thinking, decision making, living a good life is a book called Poor Charlie's Almanac. Poor Charlie's Almanac is actually a collection of speeches and writings and lessons from Charlie Munger, who was the business partner of Warren Buffett. And he's one of the person, even if someone were to ask me who's one investor or investment thinker to follow in the world, it would not be Warren Buffett. It would be Charlie Munger for me, right? For the investing mindset that he's helped cultivate in thousands of investors out in the world. So that's one book on thinking, decision making, investing. Of course, then you have Benjamin Graham's The Intelligent Investor out there, which he wrote in 1949, first published. A lot of people own that book. Most people don't read that book because it was written in 1949. Now the ideas are old and everything. If you have that book and if you've not read that book, right, I suggest 2 chapters that you read, chapter 8 and chapter 20 of the book. Chapter 8 is about how do you deal with Mr. Market, and Mr. Market for Benjamin Graham was the stock price which comes to you, a psychotic fellow which comes to you on a daily basis, right? So what he says that you need to look at Mr. Market not as an advisor but as an opportunity. So don't need to look at stock prices to get an advice what to do, but as an opportunity of what to do right and what not to do. That's chapter 8. Chapter 20 is about a concept called as margin of safety, which Ben Graham, who's called the father of value investing, says are the 3 most important words in investing ever written. Margin of safety, which simply means buying high quality businesses, not overpaying for them, buying high quality management, so all those ideas, right? So intelligent investor out there. For people who are starting out, I think Peter Lynch's One Upon Wall Street is a great book. It's a book written in a very easy language, I think, which is something which I highly recommend. And of course, these are investing related books, but there are so many other books on living, thinking, a good life, right? So Man's Search for Meaning, Viktor Frankl is a great book, I think, which is a wonderful book I recommend to everyone, right? And there's so many.
Yeah. Yeah, I saw that you had the quote from Viktor Frankl in your book too, and that's such an amazing book to think about overcoming, and using our mind.
That's right.
This is a good one. I think, how many businesses do you think a well-diversified portfolio should contain?
So different schools of thought here, but I think Peter Lynch's idea, or there's a quote from Peter Lynch where he says that owning stocks is like having children. Don't have more than you can manage, right? So of course, Peter Lynch at one time had 100 plus stocks. I don't advise 100 plus stocks, right? Buffett says you're fine with 3 stocks. Charlie Munger says 1 stock is good enough, right? But based on empirical research and based on studies across different markets, a typical portfolio, I think, should not be beyond more than 10 to 15 stocks, if you are into stocks, right? So, and this is a general advice which I give to most people out there who are not professional investors, who are just wanting to invest their money. Maximum 10 to 15 stocks of businesses that you can understand, because I'm sure you cannot understand more than that. If you want to have mutual funds, maybe 2 or 3 mutual funds out there, maybe 1 life insurance policy, 1 health insurance policy, some money in an emergency fund for emergencies, and that's it. That's the entire financial plan that you can have. Nothing more than that.
I love the simplicity. So the next question feeds off of what you just said. Should non-professional investors just buy ETF, let's say a passive ETF, and chill?
Yes, that's a simple answer. I think you should do that. So again, when I talk about investing and I talk about analyzing businesses, right? And then I also say that it's better off that 90% of the people out here, or 99%, should not invest in stocks. They should invest in mutual funds, or they should invest in index ETFs, or just do nothing. Just put your money in index ETF, a broad index ETF which tracks say 500 stocks, 100 stocks, and do nothing. And the next question is then, why am I teaching how to analyze businesses? And my response is that whatever I say, right, how much ever I tell you that you should invest in index funds, you are still going to go and pick stocks, right? So you rather take these lessons and pick your stocks somewhat wisely. And that's the reason I keep teaching about stock picking and investing. But to cut short the answer, index funds, I think, is a good idea. It's a great idea.
Yeah, it's when someone's starting off and is a non-professional investor, it could be that building up a portfolio of an index fund till you get it at 100,000 US, or whatever that size is, then have a little fun with
That's
picking.
true. That's true.
So someone's asked a question about active versus passive, and I think you've already made that point. But the second part of their question is, do you feel that passive investments increase, that will have some effect on the market? Is there a problem with passive funds as they grow in size?
I think that's a problem which is of a market like America. So US, I think 50-55% of total investment in the stock market comes from passive funds, index funds, because there's a huge concept out there. So the problem is that when passive funds hold a large portion of the market, those money managers or the guys who are running those passive funds, they have a lot of say in how the businesses should be run. Or they don't say anything about whatever way the business runs. So they are not opening their mouths in management meetings or when they're interacting with managers, and managers get away with doing anything. So I think that is the problem where in markets where you have a huge portion of investments coming through passive funds. In India, it's a very small portion. I'm not sure how the number looks up in Thailand market. But as the amount of money through passive funds grow up, I think there is this only problem which I see. Otherwise, there's no problem, because there's a problem with active money management as well. You lose money. You lose money after fees, right? So better look at low cost passive funds. So it's a smaller problem to handle compared to paying a lot of fees and then losing your money.
We've got about 5 minutes left or so, and there's still a lot of good questions. So we got to Carlos's question. Carlos asked an interesting one. Yeah. He's one of the people that didn't do anonymous, so I'll call him out. What is the most important goal you want to fulfill that you have not yet reached, and why?
The only goal is to survive. So I think I am not a big believer in goals, right? And my belief lies from the fact that goals in the future, right? Future I have no control over, right? Where I want to reach 10 years. So just to give an example, I never even expected in my wildest dreams that I am going to do what I'm doing today, in the sense the kind of work that I'm today in terms of investing, teaching, illustrating, speaking, answering questions of people with much higher IQ than I have, right? So there was never a goal, right? But I believe in systems, and systems means practicing what you think is right and what you're capable of today, right? So systems is what lies in the present, goals are in the future. And because you have no control in the future, if you only focus on the systems, and if you can only try to improve yourself, as I say, 1% every day, I think you're going to meet a goal or beat a goal that you never thought about, right? So rather than trying to foresee something in the future, just trying to improve yourself 1% every day across investing, decision making, thinking, living a life, I think you're going to meet or beat a goal that you never thought ever existed in your life. So, and an ancillary idea which I always talk about is that most of the time we live our lives as nouns, right? I want to become an investor, I want to become a writer, I want to become a teacher, right? I want to become a doctor, right? My understanding is that instead of nouns, because that defines us in a very narrow limit, if we can live our lives as verbs, verbs means action, which is unfolding on a daily basis. So I write, I teach, I educate, I draw, right? I practice as a doctor. If you can live your life as a verb and not as a noun, then you have a lot of wider horizons in front of you which open up, right? So no goals for me. Again, I end up giving a lot of long answers, confusing answers. But my understanding is, as I was talking to Carlos as well, it's like I think the simplest way or the happiest way of living a life, or the best way of living a happy life, is to live like a river. A river does not know where it's going to end up. So for a river, there's no goal, right? It doesn't know which ocean or which sea is going to end up. The only responsibility of the river is to just flow, right? And find its own path as life progresses. So if we can live a life in a flow as a river without even worrying about what happens tomorrow, because as we understood that the only thing that keeps us alive and keeps us sane, equanimous, is the idea of this too shall pass. If we just flow like that, I think we'll meet our oceans, right? Whatever is destined for us.
Yeah, that's beautiful. And I think about when I was a punk kid at the age of 17 in 1983, graduating from high school in a little town in northeastern Ohio. I guarantee nobody would have predicted I'd be up here sitting talking to you.
It's my good luck. Thank you.
It's my pleasure, and I know it's the pleasure of the audience. I have to apologize for the next question. It always comes up. Here it comes. What are your thoughts on Bitcoin?
I think Munger says it's called rat poison squared. I don't understand Bitcoin, so to put it very frankly. I put some money in Bitcoins in, I think 3 years back. And I doubled up to almost 1.5 years back. So if I were to look at my Bitcoin, it's a very small, tiny, it's less than 1% of my portfolio. That portfolio is up 50%, right? But again, Dunning-Kruger effect, the less I know, the more confident I am, I should not be, right? So no understanding of Bitcoins. I understand the technology behind it is in the right path in the sense in terms of the blockchain technology, right? But I simply don't understand the idea of Bitcoin. For me, it's more of a speculation than an investment idea.
Since we're almost out of time, I would say the last question that is here that I think is interesting is, just as the Dalai Lama had to wait 3 months to tell the child to eat less sugar, what is it that you have to wait 3 months to tell us?
Difficult question. I don't know whether I can think about it at this point of such a quick time, but I'm sure a lot of things to improve in my life as well. More patience, right? More rational, right? So be more rational, right? So that's my answer, because I myself am irrational at most times. So be more rational. I think that should be my answer. Stop eating sugar. Be more rational.
I want to end it on that, but the next question is a very good one, and that is, do you ever feel despair? And what do you do when this happens?
I have my family here, so I'm just with them all the time. So they are like my punching bags, right? So whenever I am in a moment of despair, I think I have my family to share all my grief and pain, and they have to bear with me, right? So spending time with family, reading, writing, going for a walk, right? So these are my ideas of getting through all the troubles in life. I am a very anxious person by nature, right? I suffer from a lot of anxiety every now and then. So as I said, the lessons that I am teaching are in a way reminders for me, right? That this is my way of telling you stop eating sugar, because this is my reminders for myself to stop eating sugar in various areas of life where I am eating a lot of that, right? So I think these are my ways, and probably that's the answer that I have, the best answer I can think of.
So first I want to thank the audience for all those questions. They were great, and I really enjoyed hearing your answers. And I want to personally thank you for the time that you've taken with us and the time to answer the questions. And maybe I'll hand it over to the organizers. I want to also thank Harry. I think we should give Harry a big round of applause.
On behalf of Tanwani Capital, we'd like to thank you so much for sharing your wisdom with us, Ajahn Vishal and Ajahn Andrew. And just as a small token of our appreciation, we'd like to present you with these.
Thanks so much. Thank you so much, Hari, for this opportunity. My pleasure. Thank you. Thank you.
Thank you. Yeah. Yep. Yeah. Let's get a picture. He's a little slow.
Yeah.
I would like us to thank P. Harry one more time for sponsoring this event and putting all your effort here. Without you, we cannot have this wonderful afternoon. So thank you very much, P. Harry.
Thanks, Hari. Thank you.
And I'm sure Ajahn Vishal will stick around for a few minutes to sign his book, if you wish to do so.
Thank you.